morning, and thank you for joining us today then. So I'd like to first of all start by thanking Iain. As you're probably aware, Iain is going to be stepping down at the end of this month. And I just wanted to thank him for all the hard work across the past 3 years, and he'll be missed as we go forward there. So just at a brief glance, Eneraqua, what are we? Well, we basically work with clients to help them deliver their sustainability goals. We work in two areas, energy and water, and essentially it's around helping people achieve their net zero goals, their sustainability goals, and addressing water stress. We predominantly operate in the UK, but we also have businesses in Netherlands, in Spain, and in India, and we'll cover that in a short moment as well to give you a bit of a feel there. In terms of our technology, you can see that it saves around 80 litres per household per day. We're a technology-led business. And you can see the total tons of carbon that we've saved since we started, just over 1.2 million tons. And in terms of the revenue split for last year, we're predominantly public sector. But you can see in terms of the private element, that's at 23% and growing. So in terms of FY24, the year ended in January 24, well, I have to be honest and say it was one of the toughest years that we've faced. So issues at both sides of our business. On the energy side, our domestic clients and our domestic energy projects were affected because their capital budgets came under stress. And what they decided to do was to delay some of the projects they'd agreed to do with us and push them back into this year and also into the following year, FY26. On our water side, we were struck by a surprise government announcement that came out at the end of August, which essentially delayed and potentially raised an issue where developers would not have to address an issue called water scarcity or nutrient neutrality in certain development areas. And this is where there just isn't enough water in a local authority area or a catchment area to allow development to go forward, or there's too much nutrients in terms of pollution in that area. And if you recall, Michael Gove made a statement at the end of August, and basically a lot of people criticised him. And essentially, in the end, the government delayed it and has reverted back to its policy before those announcements. But that created a problem of uncertainty, and it led to people delaying work again with ourselves. So we ended up making a loss for last year, and we'll show you the numbers in a moment. But despite those things, we did have some successes. We secured our first NHS contract of the year with Kingston NHS Trust, and we'll show how that's going in a moment. And there was greater recognition of the benefits of our technology in terms of control flow HL 2024, in terms of reducing water consumption and reducing both water and energy bills as well. Let me turn this over to Iain to take you through the key financials.
Thanks, Mitesh. So as you can see there, revenue down from FY23 levels by 2% to 53.8 million. But as Mitesh mentioned, we did see an increase in the mix of work from the private sector up to 23% of that revenue in the year. Gross profit there of 12.2 million, and that really reflects the project mix during the year, dealing largely with a higher volume of lower margin contracts, as well as the impact of those contracts being pushed to the right. It is worth highlighting, though, that while some of those contracts did deliver lower than we expected margins, none of them were loss-making. So all of this resulted in an adjusted EBITDA loss of 3.3 million and an adjusted loss before tax of 6 million. However, we were still able to continue with our investment in R&D, and the total R&D spend for the year was 2.1 million. Despite this adverse performance, we did generate a cash inflow from operations of 7.7 million, which saw our gross cash increase by 3.2 million to 6.4 million at the year end. And that overall gave us a net cash position of 1.2 million compared to a net debt position of 3 million at the previous year end.
So as I said, despite the headwinds and the challenges that we faced, we did make some progress going forward there. We had success in the NHS. You can see there's a Kingston NHS Trust with an £11.3 million contract. Despite the pressures that our domestic energy clients suffered in the year, We did also win a £12.7 million contract with the Royal Borough of Kensington and Chelsea. So this is for an estate called Lancaster West, which is essentially the estate surrounding Grenfell Tower in West London there. However, despite that, we expect the domestic sector to not normalise completely until probably FY26 next year. We haven't lost any clients, and we didn't lose any projects, and that's really testimony to the hard work of the team. And we're still continuing to win new ones as well. But as I say, in the domestic sector, it won't come fully back on stream until 2026. Post-period end, our acquisition in Holland has continued to grow, and we're on course to basically double the revenues in the first 12 months there. And similarly, in terms of the non-domestic sector, we also secured 4 major contracts, each of them being 4-year appointments. In terms of water, again, with stability on UK water government policy, we've now pushed on with our net water and net nutrient offerings into the marketplace there. We won our first net neutrality contract, and that's with Ashford Borough Council in Kent. And they're basically installing our products in 5,000 of their existing homes to unlock a 1,000 home development that's been stuck in planning for over 18 months there. In Spain, we're again seeing demand across a range of sectors. And in India, it's quite exciting because they've actually realized the technology has benefits for them in their domestic programs. But the issue they've got is scarcity of water, and the need to make sure everybody gets a fair amount of water. So in that application, we've just completed a trial of 1,000 homes, and we've got a further trial of 3,000 homes coming up. Now, at the moment in India, of course, you've got the elections going on, which are complete at the end of June. But once those are complete, we expect to make further trials and further progress in this exciting sector. And back to Iain again.
So group revenue and the highlights. As Mitesh has mentioned, no contracts were cancelled during the year, just pushed to the right. So we expect those to either start in the current financial year or FY26. And as with all of our years, whether they're good or bad, we will continue to see an H2 weighting to the delivery of those projects. As I touched on earlier, we have seen that growth in the private sector work. And in addition, we also saw growth in our international revenues. They grew by 138% to 1.3 million and expect that growth to continue as we move forward. FY25 has started well so far, and we remain on course to return to profitability in H2 of this year. With regard to our order book, you can see there that it totals just over 102 million, of which 88% we expect to deliver during the current financial year, with 18.5 million already delivered by the end of April. You can also see there we have a potential pipeline of circa 700 million. And if you remember, when we're talking about our pipeline, those are the projects where we believe we've got greater than 50% chance of winning. Income statement, you can see there the comparison against FY23. I've touched on a lot of these points. It's just worth highlighting that growth in admin expenses reflected the continued investment in our headcount, particularly within engineering and project management. We did, however, carry out a restructuring exercise towards the end of last financial year, and that saw us remove a number of heads and reduce other cost areas, all of which should give an annual saving of approximately £1 million. And that's now beginning to take impact in this current financial year. We continue to see a challenge around recruiting engineering resources. And this year, we're looking to utilise our colleagues in India, particularly within their engineering team. And that will allow us for our UK engineers to supervise their work to ensure that the quality standards are maintained whilst providing a cost benefit to the group. So here we have a net debt bridge. So you can see that we started the year with a net debt position of £3 million. And with the key drivers during the course of the year, we have benefited from the unwind of the FY23 accrued income. Now that's been partially offset by a growth in contract assets. So that overall, that gave us a £5.5 million inflow, being the movement in those trade and other receivables. We also saw a benefit of 8.1 million from the increase in trade and other payables over the period. And that's largely a result of the year end, where we accrued for a number of costs in relation to projects where we delivered at the year end, but where we had yet to receive the invoices from suppliers. Those invoices have all now been received and paid post year end, and we currently have our creditor days running at 59 days, which is down from FY23's levels of 66 days. We did have some capex in the year, albeit it was limited, totaling 1.4 million, and of that, 0.8 million was intangibles, largely the goodwill on the acquisition of Rend and the investment in the R&D projects that I mentioned earlier. So all of this resulted in a closing net cash position of 1.2 million at the year end.
Thanks, Iain. So looking in terms of our strategy, as a company, what we do is we deliver solutions to basically our clients' needs. On the energy side, we work in both domestic projects, but also, as you've seen, in the non-domestic buildings there. So things like schools, hospitals, leisure centres and the like. On the water side, we do a lot of work in domestic homes for water companies and for private householders as well, and of course for developers now. But we also work for commercial buildings such as schools, hospitals, care homes and hotels as well. Some of the numbers there you can see there, I'll just highlight a couple. So in terms of the energy work, typically our work delivers up to 70% reduction in the carbon emissions from buildings, with a 45% cut in people's actual energy bills. In terms of the water side of it, the Liverpool University looked at our programme in Crawley Council and determined that actually householders are saving up to £365 a year on their energy and water bills as well. So these are sort of big numbers, and particularly on the water side are really underpinning the point that people now understand actually this technology is a bit of a game changer. So in terms of our technology, as I said, what it does, it gives you very precise flows coming into a property or coming out of a tap if you fit it near the tap unit. And it takes away those fluctuations. So essentially it's saving people, based on actual water meter data across a 5-year period, an average of 23% in people's water consumption without actually the resident having to change their behaviour at all. And in terms of client satisfaction, in terms of household satisfaction, it rates at about 98.9% satisfaction. So people like the water supply, they just don't know that they're saving 23% of what they were doing before. And now the IP, of course, was the main reason that we went to IPO and came to the market to actually completely acquire the IP. And the R&D investment we've been doing is to build out our range of products so we can offer solutions for any application in the building sector that we come across. So in terms of our market sizes then, the markets that we service there, so you can see in terms of energy, and this is really the domestic energy market, but we see that as being over £4 billion per annum in terms of both Holland and the UK, which is where we offer our energy solutions at the moment there. That number, of course, is increasing as we're now pushing into the non-domestic sector. In terms of the water side, it's again a similar story. So you can see that we estimate about £2.4 billion. But application opportunities, particularly in India, in the domestic sector, are going to push that up substantially more. So in both markets that we operate in, the total size is actually increasing. And what is our growth strategy? Well, in terms of energy, it's really around growing the non-domestic sector, particularly in the UK at the moment. We've got new contract wins in the domestic sector, but as I said earlier, we don't expect this area in the UK to come back to normality fully until FY26, next year effectively. We're still going to continue investing in internationally in Rend, in Holland, and basically push on with expansion in that area in Holland. In terms of water, we're building on the demand for water and nutrient neutrality solutions. One of the questions that people ask is, what about the election? Well, actually, both parties want to get more house building, want to get more construction under the way. And that means they need to get development in the 74 local authority areas where these two issues really apply. And right now, the solution we offer is regarded as the lowest cost proven solution available. We also want to expand our offering in India, as I spoke about earlier, and push on into the domestic sector more strongly. In terms of R&D, again, we're growing and developing our capability. And again, we're looking at new applications, particularly in agri-tech, where to take that forward, as well as protecting and finessing our core product set as well. In terms of merger and acquisitions, as you'd expect, this is something which we're going a little slower on, but we are keeping an eye on where we can see new technology opportunities, or when we come to look at new regions or countries we want to expand in. I mentioned some of the success areas we've had this year. Kingston, of course, the first NHS trust that we've won. This is driven by the fact that we made the acquisition of Mathieson there previously, that had a track record of working in the NHS, and it allowed us basically to bid for NHS contracts. Now, this contract, when we originally landed, was an £11.7 million contract, and the client in the first few months of our work is so pleased with us, it's actually increased it by a further £1.1 million. In terms of Islington, this is a 4-year appointment to essentially go through a decarbonisation of their public buildings. And the first year will see us basically installing heat pump solutions into up to 10 sites there. And then you can see the second phase of works, which we're now surveying, etc. We'll see that grow in further years later on. In terms of Kensington and Chelsea, this is the domestic project, the estate around Grenfell Tower. And again, that's going really well with a very happy client. So these 3 projects this year are going to have, in terms of revenue terms, worth just over £20 million. And if you look at the overall in terms of the lifetime of these contracts, for us, we estimate they're going to be worth just over £60 million. In terms of water, again, the first one is in Holland. It's a hospital site where essentially they installed our products, and what they found is they're going to get a recoupment of their cost investment within the first 12 months. The middle one is actually the domestic trial that we've completed, and that's going on now for the further 3,000 homes. And again, the results are really good. So what they're talking about is what they term equitable supply needed. It means that everybody gets a fair amount of water. And essentially what they found with our technology is this is what happens. To the extent that when they've surveyed the residents at the beginning of this month about what they felt, the residents said to them, actually, we're prepared to pay for our water because the water actually comes out of the taps and everybody gets a fair shake. Crawley and Stoneborough, of course, are the 2 that we've got on water neutrality. These are projects that we started last year. Crawley is the larger one, and that's going extremely well. So we've completed 2,400 installs for them and unlocked 750 new build housing, with a target that they've got to unlock effectively 2,000 new build properties. And on the way, we've also unlocked a Taco Bell and a KFC as well. So as you can imagine, we're into healthy food eating there. So as I say, there's no getting away from it. FY24 was an extremely difficult year because of the issues around government and water, but also in terms of our local authority clients having serious pressures on their capital budgets. And basically, those 2 things really hit us hard. What we went and did was actually, we met the revenue and adjusted PBT as per the final consensus numbers that came out. And in terms of cash, we were slightly stronger than expected. And we finished, as Iain explained, with £6.4 million of cash, representing 1.2 million net cash there. We signed our contract with Crawley during the year, and excitingly, the commercial energy projects really started to emerge, and they continue to grow. For FY25, because we're shaping up in a really good place in the first 4 months that's gone through. And again, our international expansion continues, and we talked about India and why it's exciting for us. So the final slide before we move on to your questions, what I'll just reiterate in terms of looking ahead, the demand for what we do in our solutions remains strong. Net zero targets haven't gone away, and water stress has certainly not gone away at all. At the moment, because of that and the progress we've seen, we're on course to meet our targets that we set ourselves for FY25. We can see good growth opportunities internationally going forward, particularly in Holland and in India as well. Our domestic energy market is not going to come back to normal until next year. But as I say, for our non-domestic, that's already returned to normal and is growing very, very strongly there. In terms of normalization, the legislative environment, despite the election, has normalized. And I think, again, in terms of water, we have confidence, and certainly our clients can have confidence about the solutions that they need to use. So our expectation, as I say, is to return to profit in H2 of this year. And in terms of revenue growth, we've returned to a growth trajectory. So let me pause there and give you the chance to ask your questions.
Do you expect the large working capital improvement as a result of the payables/accruals at the year end to be maintained in full year 25 or to unwind, thereby putting significant pressure on cash resources during full year 25?
No, I would expect it to be able to maintain the position. So, for example, as we sit here today, we currently have gross cash of £4.6 million and an unused overdraft position of £2.5 million. So whilst working capital management remains a key focus, I don't expect it to come under undue pressure during the course of the year.
And can you expand on developments in the non-domestic area and what traction you're seeing?
Absolutely. So what we're seeing in that is that we've got clients coming forward who essentially want to decarbonise, and they want to move to a heat pump solution there as their plant rooms are coming to end of life there. The solution that we have and the approach that we take and the quality of service that we provide is really attracting attention there. And when we're putting into proposals and tenders and the like, people are noticing that and are asking us to come forward with solutions. So we see the non-domestic sector being a very strong growth focus for us. And again, in terms of the election that's going on right now, both parties, both major parties, in terms of both Conservatives and Labour, are committed to really driving forward in this area. So Labour is committed to actually doubling the amount of incentives being offered to public sector organisations to decarbonise. And again, the Conservative Party is maintaining the current programme, which again is expanded substantially. So we really see that as a major growth opportunity in a growth area.
What opportunity do you see in water in the short and medium term?
Sure, that's a very good question there. So in the short term, we're seeing growth in terms of traditional markets where people need to save water. The water companies have water saving targets they need to achieve. So we've got that sector there. We've also got private developers in terms of unlocking development going forward. Both developers and local authorities are looking at our solutions going forward there. And we're also seeing applications for hotels, residential care homes, and again, the NHS and the hospital sector, where again, people are recognizing that they can save water and save bills very, very efficiently without any impact on their care or customer experience. In the medium term, we expect those growth curves to continue, but it's an international opportunity. Water is an international growth area for us. So we do expect to expand our offering into other territories going forward.
And do you expect to be cash flow positive in full year 25?
Yes, is the short answer. Undoubtedly there'll be fluctuations during the course of the year as we deal with some of those larger projects coming on stream, but we expect to end the year in a net cash position again.
Do you expect gross margins to recover in full year 25? And would you hope to be back to 2023 levels of profitability in 26? And what do you need to happen to get there?
So dealing with the margin point, yes, we expect those to recover in line with the forecasts from the analysts. That's probably going to come through in the second half of the year for us. So in terms of returning to the profitability levels in 26, I think that really would depend on the normalisation of the domestic energy market that Mitesh talked about, as those projects do tend to be at a higher margin than the non-domestic sector.
And would future M&A be infilling into the UK offering or overseas expansion?
We'd be looking basically at M&A to probably grow our international part more than doing infill into the UK there. And we'd also be looking at potentially around technologies. If there are other complementary technologies there, we may look at acquiring those going forward.
And a little bit of confusion about the R&D spend in full year 25. Can you confirm what you expect the spend to be? The questioner says it was 2.1 million in today's RNS versus 0.5 million in the Liberum forecast.
So that's the 2.1 is the total figure. The 0.5 is the R&D that we were able to capitalise onto the balance sheet. So the balance is essentially costs we've incurred in R&D that we've expensed through the P&L account.
And that's the end of questions. So, Mitesh, do you have any closing remarks?
Thank you there, Tamsin. Well, can I just say thank you for joining us today and asking some very good questions. It has been a rocky year for us last year, but as I say, we've recovered, got through that, and we'll be returning to profitability in H2 of this year and returning back to our growth curve there as we expected. So thank you again for your time this morning.